Welcome to the latest Motley Fool scoreboard. I'm on in Chocolate and we've got longtime fools Jason Hall and Travis Hoium giving a 1 to 10 rating to a company that's into its third decade of being accused of being a fad. It's Crocs, ticker symbol CROX. We'll rate the strength of Crocs' business first, including factors like industry, competition, and gibbets. A 10 is invincible, a 1 is hopeless. Jason's at a 7. Travis is at a kind of a torn 6.
Yeah, I gave it a 6. Look, the Crocs brand is a 9. The Heydude brand is a 3. Average it out, you get to a 6. I think that's the right way to look at the business. If I was only buying Crocs today and you were getting it for about a 6 price to earnings multiple on a forward basis, that'd be a phenomenal stock to buy. Problem is you're also getting Heydude. That has been kind of a disaster for the company.
Yeah, I'm not going to argue with that, but one of the things that we've seen is since that stupid $2 billion investment almost 5 years ago, it's steadily become less relevant and less impactful on the top and the bottom line. So if you really look at the overall business, my 7 is because I think it's going to continue. It's very profitable. It's going to continue to be able to outgrow GDP in its core markets across the economic cycle. Things don't look great right now, but nobody doesn't look great for anybody. Those steady margins, even in weak sales periods, they've continued to improve. In the aggregate, I think a 7 is a very deserving and a very good score for this kind of business.
Right. We're assuming everyone knows Crocs, the ugly shoes, but just in case. Management,
I will tell you, I'm wearing Crocs right now, and it just would be weird to take them off and show people. But these actually look pretty nice. They're like a canvas khaki color, and you'd never know they were Crocs.
Okay,
we're not taking fashion advice from Jason.
Right.
That's fair.
For management, a 10 is Warren Buffett. Someone else I wouldn't take fashion advice from. A 1 is Homer Simpson. Yet another. Jason's at an 8. Travis, you're at a 6.
Yeah, Andrew Rees has been there for a long time. I think it's since 2014 as CEO. Grown the business significantly. The fact that Crocs is still as relevant as it is today as it was a decade ago, maybe even more relevant, I think is really a testament to his leadership. All that said, I can't go particularly high here because he was in charge of the Heydude acquisition. So when you make a mistake that big, you've got to kind of knock things down as a CEO.
Yeah, I'm going to push back a little bit on that because it's true. But that one mistake, I don't think it completely outweighs all of the other evidence that overwhelmingly says that Rees has done a good job. And it's not often you have a hired gun consultant that comes in. He actually was the president when he came in 2014. He was promoted to CEO in 2017. But if you look at either of those periods, when he came in to the business, the stock is up an annualized 24%. And then when he was named CEO, it's a 10-bagger for shareholders. Revenue's up 4x over that period. Free cash flow per share is up 25x. Dumb $2 billion overpay. But since he went to work for the business, they've bought back almost a third of the shares. So they're making other really smart, sound financial decisions under his leadership too.
Question I have is about the lieutenants. You would think someone would have been like, hey, dude, maybe we should just focus on organic growth. For financials,
did you say, hey, dude? I have an idea.
Too many puns here.
What is yikes? Jason's at a 7. Travis, you're at a 6.
Yeah, the financials even 6 months ago, I probably would have been higher than this. Like Jason said, a solid free cash flow company. They're buying back debt and they're buying back shares. Yeah. So the risk profile of the business is really improving. The reason that I'm not going to go particularly high right now is over the past couple of quarters, they have pulled back on their guidance. They've gone to now negative growth for kind of the second half of 2025. So I'm a little bit worried that there's some sort of rot there underneath rather than sort of these shiny, pristine numbers that kept beating estimates, through 2024, early 2025. Maybe we get back to that, but I'm a little bit worried right now.
Yeah, dude, Heydude. It really is. You look at the revenue there, it's way down. That's hurting the business, but even the core Crocs business is pretty weak. But again, you look across the apparel and footwear business, and most of these branded businesses are struggling right now. So to me, that says it's more macro. So I'm less concerned about the weakness that we've seen. And even during this period where we're seeing some weakness, continues to hold really good margins. Now, the balance sheet isn't perfect. It's like about 10 times more debt than cash. But that's just because there's not a lot of cash. Part of that's timing, heading into, this is an inventory build period as we're heading into the holiday season, which should be pretty good. But the big thing, you mentioned it before, buying back debt. They continue to buy back little nibbles of debt, and they've cut debt in half in 3 years. So they made a bad investment to buy Heydude. They're paying the price, but they've also reduced the balance sheet risk by paying down that debt. And I think that cash engine is going to keep chugging along even through the weak part of the cycle. And I think on the other side, it's going to do pretty well.
It's like Meta investing in the metaverse is just so profitable that they can kind of do it. Jason, let's go on to the valuation. How well will Crocs stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
So I will say the difference, though, is that just because you can doesn't mean you should. And Crocs should be paying down debt. Whether Meta should be investing in the metaverse, we will find out at some point in the future. So back to valuation here. I'm thinking 10 to 15% returns. I see more value, less trap, foreshadowing Travis, maybe sees some potential risk there. My safety score is a 7, 6.2 times free cash flow. Yes, there's a risk that cash engine runs out of gas, right? But I think if you look at the quality of the business, the macro environment, likelihood that that's going to be improving in years to come, Crocs is cheaper than it's ever been under current management. It's a really, really good business, and I think it's a more reasonable price. And I mentioned it before. Heydude only makes up 17% of sales this last quarter. It's becoming less relevant. So even if there's some upside from that business, it's going to help boost things.
Yeah, Heydude is kind of declining into oblivion. That's why I went with 15% plus. Look, this is not a sure thing, so I went with this pretty low safety score of 4. But you are getting a company that is a pretty good value. Margins are down a little bit, so that value may even look a little bit better if things do turn around. And if we get any sort of turnaround at Heydude, even if those comparable numbers just go positive instead of being negative,
or just stop falling. I mean, just stop declining.
This could be a company that you benefit from a little bit of growth, great value, and then multiple expansion. That's why I think the upside is pretty high here. Like you said, it did 10x for investors over the last decade or so. So we could potentially do that again, but it's definitely not a sure thing.
Thank you both, Travis and Jason. They've given Crocs a perhaps surprisingly solid overall score of 6.9 out of 10. Feel like it's a stock investors almost always underestimate. While Jason doesn't really like this space, Travis prefers On Holdings as a top it. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Netflix. Till then, Fool on.